Hey, Adam Hooksomer here from ProjectionHub, and in this video, I'm going to walk you through our coffee shop financial projection template. This template is built to help you raise capital from investors or lenders. Like if you're trying to get an SBA loan and the lender asks you for a set of financial projections, this template is going to be a perfect fit to help you do that. I'm going to walk you through each of the tabs here and show you how to fill it out. Before I do that, though, just a little bit of my background. I was an SBA lender myself for 12 years, closed about 1,500 SBA loans, including a number of loans to coffee shops. And so what we've built here is really a tool that is going to help you meet the SBA requirements in kind of their standard format. And so hopefully this is going to be helpful as you're probably panicking, trying to figure out how do I put together these numbers for my lender. So, all right, with that, let me go ahead and dive into how this works. So the first tab here is the at a glance tab. This is just a number of high level charts and graphs and tables that you can put into your business plan. And then there is a 5-year income statement summary, a 5-year cash flow summary, 5-year balance sheet, and then the income statement, cash flow, and balance sheet broken down by month for each of the 5 years. So in order to produce these reports, though, we've got to fill out these blue input tabs. So the first thing we're going to look at here, we're going to set our start date. We can set an opening cash balance if you're already open. You can set how much investment you are putting in personally. So if you put month 0, that means you've already invested it. So for example, this is probably the way this would work is, hey, I put 10,000 in, but it's all just sitting in the cash account right here in the checking account to start to seed the business, right? And then say maybe we are looking to raise an additional $50,000 of equity investment here in month 1, or basically when the business starts. So you can put in, your equity investor money. And then accounts receivable, this just means that you're going to get paid 100% of your sales when you make the sale. So like you hand someone their coffee, they're paying you right then, right? And you're not giving anybody terms. Accounts payable, we're assuming you're paying 80% of your bills in the month you incurred the expense, 20% on a 1-month delay. And then inventory, you'll start out with a little bit of inventory on hand, and then you'll keep some small percentage of inventory. You'll probably get inventory delivered on a regular basis, maybe weekly basis. So you're probably not keeping a whole lot on hand at any one time. Okay, so here's maybe our different startup costs. So let's say we're going to have $60,000 for leasehold improvements or renovations to the space, $15,000 for equipment, $10,000 for furniture, and then $2,500 for glassware. And maybe we are getting a loan from friends and family for $10,000 and maybe an SBA loan for $100,000 to round out our funding. Okay, so let's move on to our revenue model. So here, what we're going to do is we're going to say, okay, well, how are we going to get customers? That's what a lender's going to want to know. You don't want to just say, we're going to build it and they will come. That's probably a bad thing to tell your lender. So you need to say, okay, we're going to have an advertising budget each month. We think, based on our research, or maybe you did an experiment, or you've worked in a different coffee shop and run their advertising campaign, but maybe we say, okay, we think it's going to cost us $10 to acquire a new customer. And if we spend $500, we're going to get 50 new customers a month from paid ads that are going to be willing to try us out. And we think we're also going to get, initially when we first open, we think we'll do some grand opening marketing. We're going to get a couple thousand people to try us out in the first month, and then maybe 1,000 a month after that of new organic visitors. So one of the things that I often do in a model like this, unless you're in a really fast growing area, you might actually want to put a negative growth rate here. So you might say, well, actually, eventually all the people in town are going to have tried us that are ever going to try us. And then, we're going to have a harder and harder time getting new customers. So this may actually need to go down this goes down by 10% a year. So each month you're kind of getting less and less new customers. And by the end of, the 5-year model, maybe we're only getting, instead of 1,000 new customers a month, we're getting 600 new people that are willing to try us out. And honestly, this may be way too many customers for you based on your location, right? Again, if you're in downtown New York City, okay, maybe that's very reasonable. If you are in a small town in Indiana, like where I'm from, this is probably way too aggressive, because only some small percentage of the population is really even going to try your shop, right? And so you need to think about, as you build out these assumptions, you need to think about where are you located, what's your concept, what's reasonable. Okay, so then what we're trying to do is build up regular customers. So we want to say, okay, let's say we start out with, we've got 40 people who are really behind us and excited about the shop, and we know they're going to come on a regular basis. So we're kind of starting with our existing regular customer base. And then from there, we're going to have some percentage of our new visitors are going to become regulars. So we're saying, okay, well, we had 2,000 new visitors. We think in the first month, these people are early adopters. Maybe they're more likely to become regulars. And then as over time, those new visitors are going to, less and less of them are probably going to become regular visitors. Okay, so now we've got this calculation here of this total active regulars. These are the folks that come back on some regular basis, a monthly basis, maybe not daily, but they're coming back, monthly, let's say. And so we can set the number of visits per regular per month. So we're saying, okay, on average, these people that we're considering are regulars, they're going to come on average 1.2 times per month. So based on all that, we're ultimately, what we're getting to here is we're trying to calculate the total number of customer visits we think we're going to get in a month. Now, depending on your concept, if you're really more focused on we want to have a small group of people and they come every day. They work from the shop. They're coming on their morning commute. They're coming every day. We built a habit. If that's the concept, then this number, you may have way less customers that come way more often, or vice versa, right? So, or somewhere in the middle, really. It could be any of those approaches, but that's what you need to kind of think through. So ultimately, then this is going to help you calculate your number of customers per day and customers per hour. You need to gut check this. So what I often suggest, small town Ohio, 119 customers per day may be way too high. And in New York City, this may be way too low, right? So it's going to vary a lot. What I like to suggest is put these numbers together, then go to a competitor in a nearby town or city, or in the same city, go to a competitor, sit out in front of their building for a day and just count how many customers they have. Figure out whether this is possible. Is this realistic? Are you way off base? Based on what others are actually experiencing. Okay, so then what you do, once we have our number of customer visits a month, now we're saying, okay, well, what are those customers going to buy? Well, here's our different menu options. Here's our prices. Here's our cost so we've got a $3 basic coffee. It costs us 75 cents is what we're saying here. And what we're saying here, this average number of purchases per visit, we're saying 0.2 or 20%, basically 20% of these visitors are going to purchase a coffee. And we're thinking 60% of our customers are going to purchase a espresso drink, and 10% are going to purchase a sandwich, right? So that's how you would enter that in. And once you enter all that in, again, your gut check can be, hey, our average customer, the average spend per person on coffee and food is $7.23. So that's your average order value. Does that make sense? Does that seem reasonable? And then, again, here you can set inflation rates. Maybe we just set that to 3%. All right, here's where you can enter in your direct labor. How many hours of direct labor are you going to need per week? How many days? And then extra hours to open and close. And then what we can set here is the minimum number of employees per operating hour. So we're saying we need at least 2 baristas. We're going to pay them $16 an hour plus 8% taxes and benefits. The maximum number of orders per hour per employee that they can handle is 30. So what the model is going to do is if you get too busy, it's calculating down here based on your projections of customers, how many orders per hour you're getting. If this ends up getting to be more than what your direct labor can handle that you have in here, the model is automatically going to add staff. But it's going to default to say, well, we need at least 2. And then if our projections show that we need additional based on how busy we are, it will automatically add additional staff. So that will be your direct labor expense here. And that's really it on this page. Now, our operating expenses here. So here you can put things like accounting, your point of sale system, your transaction fees. So you can set this as a percentage of revenue. So this could be credit card processing fees. Maybe if you're taking gift cards, the gift card company is going to, take a fee out of that, as well as a payment processing fee, probably. That's what you can enter in here. You can enter in your rent, utilities, supplies, workers' comp, repairs and maintenance, all those sorts of operating expenses. And then we can enter in our salaried position. So we already had the direct labor for baristas, but if we want to say, okay, we're going to have a manager and they're going to start in month 1 making $45,000, and then they're going to work, from month 1 to month 60. So the whole 5-year model. But we're going to get a second manager as we start to grow. We're going to get a second manager in year 2, starting in month 13, and then maybe in month 37, we're going to get a store supervisor, general manager type of position that maybe takes the place of what you do as the owner. So you can set those salaries in there. And that brings us all the way back to kind of where we started. So in this example, based on all that information, we had a small net loss in the first year. Probably makes sense. I think as you're building up a customer base, it probably makes sense that you're going to have a small loss, at least in the first year. What I would also take a look at as you fill all of this out is that you're going to make sure your net income percentage and EBITDA here is not too high. Very few coffee shops are going to be doing like 25% profit margins. You're going to be probably pretty low profit margin business. It's a tough business to run. And so that's probably where you need to be. And you don't want to present something to a lender that shows, we're going to have 50% profit margins, because the lender's going to say, nope, probably not. If you're performing better than Starbucks, like probably something's wrong in your model. So that's what you want to do to kind of gut check this as you're kind of wrapping this up and before you send it to lenders. So, all right, I hope this has been helpful. If you have any questions, please let me know. If you're looking to get an SBA loan and you'd be interested in my feedback, I do offer a free SBA review. I'll put a link in the description of the video below to that SBA review form that you can fill out and give me a little bit more information. I can give you some free feedback. And then we'll put the link to this template in the description of the video below. So take a look at that, and I hope this has been helpful. All right, thanks.